Most retirees believe that once they leave the workforce, they have finally escaped the most stressful parts of dealing with money. No more payroll taxes. No more complicated deductions. No more worrying about what the IRS wants from them. But here is the truth that nobody warns you about. Retirement is actually one of the most tax-dangerous periods of your entire financial life. The IRS has a set of rules specifically targeting retirement income, retirement accounts, and the benefits that retirees rely on, and millions of Americans are unknowingly breaking these rules every single year. The result? Penalties, unexpected tax bills, and losses that can easily add up to $50,000 or more over the course of retirement. Today, we are exposing 7 of those rules, so you know exactly what they are, why they exist, and most importantly, how to avoid letting them drain your retirement savings. Welcome to Rule by Seniors, the channel built specifically for retirees and pre-retirees who want to make smarter, more informed decisions about their money, their benefits, and their financial future. On this channel, we cut through the confusion and give you clear, practical information that you can actually use. If you are new here, please take a moment right now to subscribe and hit the notification bell, because every week we publish content that could save you thousands of dollars and help you protect the retirement you worked so hard to build. Now, let us get into these 7 IRS rules that are quietly costing retirees across America a staggering amount of money. And let us make sure you are not one of them. The first rule involves required minimum distributions, and it is the one that catches more retirees off guard than almost anything else. When you reach age 73, and this age has changed multiple times due to legislation, so always verify the current threshold. The IRS requires you to begin withdrawing a minimum amount from your traditional IRA, 401k, and most other tax-deferred retirement accounts every single year. This is called the Required Minimum Distribution, or RMD. The amount you must withdraw is calculated based on your account balance and your life expectancy, according to IRS tables. The rule exists because the government allowed you to defer taxes on those contributions for decades, and they want their share before you pass the money on. The penalty for failing to take your full RMD is one of the harshest in the entire tax code. The IRS can assess a penalty of up to 25% of the amount you failed to withdraw. On a missed distribution of even $20,000, that is a $5,000 penalty, just for 1 year. Many retirees who have multiple accounts, inherited IRAs, or who recently reached the RMD age miss this entirely, especially if they switched financial institutions or forgot about an old account. The fix is simple once you know the rule. Calculate your RMD for every qualifying account each year, take it out before December 31st, and keep records to show you complied. The second rule that costs retirees enormous sums of money involves Social Security taxation, and it surprises almost everyone the first time they encounter it. The popular belief is that Social Security benefits are tax-free income. That belief is wrong for the majority of retirees. If your combined income, which the IRS defines as your adjusted gross income plus any non-taxable interest, plus half of your Social Security benefit, exceeds certain thresholds, then a portion of your Social Security becomes taxable. For individuals with combined income between $25,000 and $34,000, up to 50% of their Social Security can be taxed. Above $34,000, up to 85% of the benefit can be taxed. For married couples filing jointly, the thresholds are $32,000 and $44,000 respectively. What makes this rule especially painful is that many retirees do not find out about it until they receive an unexpected tax bill at the end of the year. The solution is to work with a tax professional to project your combined income before year end, and, if necessary, adjust your withholding or make estimated tax payments so the bill does not come as a shock. The third rule involves early distributions from retirement accounts, and it catches people who retire before age 59 and a half. If you withdraw money from a traditional IRA or 401k before reaching that age, the IRS levies a 10% early withdrawal penalty on top of the ordinary income tax you already owe. For someone in a 22% tax bracket who withdraws $30,000 early, the total tax and penalty cost could exceed $9,000 in a single transaction. There are exceptions to this rule. Things like substantially equal periodic payments, certain medical expenses, disability, and a few others. But these exceptions have very strict requirements, and misapplying them can make the situation worse. If you are planning an early retirement, understanding the strategy of using taxable brokerage accounts first, then tax-deferred accounts after 59 and a half, can save you tens of thousands of dollars over time. The fourth rule involves the Medicare Income-Related Monthly Adjustment Amount, which most people know as IRMAA. This rule is not technically an IRS rule, but it is triggered by your tax return, which makes it directly connected. Medicare Part B and Part D premiums are not fixed for everyone. They are income-based. If your modified adjusted gross income from 2 years prior exceeds certain levels, Medicare charges you a surcharge on top of your standard premium. In 2026, the surcharges for higher income retirees can add hundreds of dollars per month to their Medicare costs. The crucial thing to understand is that this is based on your income from 2 years ago, meaning a large one-time income event, like a Roth conversion, a home sale, or a large IRA withdrawal, can push you into a higher IRMAA bracket and increase your Medicare costs for an entire year, even if your income returns to normal. Strategic income planning, particularly around the timing of large withdrawals and conversions, is essential to avoiding this invisible penalty. The fifth rule is about inherited IRAs, and the Secure Act has made this area dramatically more complex and expensive than it used to be. Before 2020, most non-spouse beneficiaries who inherited an IRA could spread distributions over their entire lifetime, minimizing the annual tax impact. The Secure Act largely eliminated the stretch IRA and replaced it with the 10-year rule, meaning most non-spouse beneficiaries must now completely empty the inherited IRA within 10 years of the original owner's death. For a large inherited IRA, this means potentially recognizing a significant taxable income event every year for a decade. If the beneficiary is in their peak earning years, say in their 40s or 50s, this inherited income can push them into the highest tax brackets for an extended period. Beneficiaries who do not understand this rule risk waiting too long, compressing withdrawals into the final years and triggering enormous tax bills. Understanding the 10-year rule and spreading distributions thoughtfully across the full decade is the key to managing this correctly. The sixth rule involves the taxation of pension income, and it applies to retirees who contributed after-tax dollars to their pension plans at some point in their careers. Under the IRS General Rule and the Simplified Method, a portion of each pension payment may be tax-free because it represents the return of your own after-tax contributions. However, many retirees either fail to calculate this exclusion correctly or never claim it at all, paying full ordinary income tax on their entire pension when they legally do not have to. The math involved in this calculation is genuinely complicated. It depends on your age at retirement, the amount of after-tax contributions, and the expected number of payments, which is why many people either get it wrong or give up and overpay. Getting this right, especially over a 20 or 30-year retirement, can represent a meaningful tax savings that compounds year after year. The seventh rule is one that retirement savers often overlook because it involves something they think is a simple administrative action: the IRA rollover rule. The IRS allows you to roll over funds from one IRA to another, but there is a critical limitation. You are only allowed one IRA to IRA rollover per 12-month period across all of your IRAs combined. This is not per account, like it is across all accounts. If you take a distribution from one IRA intending to roll it into another, and you already completed a rollover in the past year, that second distribution becomes fully taxable, plus subject to the early withdrawal penalty if you are under 59 and a half. A simple paperwork mistake or a misunderstanding of this rule can result in an unexpected and completely avoidable tax bill that could easily run into thousands of dollars. The safest way to move money between IRAs is always through a direct trustee-to-trustee transfer, which does not count as a rollover and has no once-per-year limitation. These 7 IRS rules are not obscure technicalities buried in the tax code. They are real, everyday traps that affect real retirees across this country every single year. The difference between a retiree who loses $50,000 to penalties and avoidable taxes and one who keeps that money in their pocket often comes down to one thing: knowledge. And that is exactly why Rule by Seniors exists. We are here to make sure that you have the information you need to protect your retirement, maximize your income, and avoid the costly mistakes that nobody warns you about until it is too late. If you found this video valuable, please give it a thumbs up. It genuinely helps other retirees who need this information find it. Share this video with a spouse, a sibling, a friend, or anyone you know who is approaching retirement or already in it, because the rules we covered today could affect them directly. Subscribe to Rule by Seniors right now if you have not already, and make sure you have notifications turned on so you never miss an update. We cover Social Security strategy, Medicare, tax planning, estate planning, and all the financial topics that matter most during retirement. And we do it in plain language that anyone can follow. Drop your questions in the comments below. Our community is active, and your question might even inspire our next video. Until next time, protect your money, stay informed, and remember, retirement should be earned, not eroded.